Hey guys, welcome back. Today we'll be going through shares. In the last video, we went through the company, the directors, its functionalities, but in this video, we'll focus more on the shareholders. So, remember that document that we talked about, the Memorandum of Incorporation? The MOI of a company will also stipulate the authorized share capital, which is the maximum number of shares that the company may issue. And it is a very important thing to look at for a shareholder because they may actually stipulate or decide your percentage holding in the company and what it could be. The MOI will also stipulate the different classes of shares because they're not all of the same breed, they're actually different types of shares. And these different types of shares have different rights attached to them. Some might earn fixed returns, while other shares earn returns which are dependent on the profit earnings of the company. And some classes of shares might enable the shareholders to vote for directors at the AGM, while other classes have no voting rights. Some classes of shares may actually be sold to members of the public, like on the JSE or the New York Stock Exchange, while other classes might not. The MOI might also allow for certain shares to be converted to other classes of shares under very specific conditions. And there are actually two major classes of shares, which are ordinary shares and preference shares. But for the purpose of this video, we will focus on ordinary shares. And throughout grade 12, you will actually not learn about preference shares nor be tested on them. And the thing is, there's actually what we call issue share capital, which is the number of shares that have actually been issued out and are different from the authorized share capital. So the authorized share capital is the maximum, while the issued share capital are those that are actually issued out. And the directors, remember that the directors are the one operating the business and not the shareholders. So the directors might not want to issue out all of the shares of the company at the starting point, but might want to issue the rest later at a later stage, whereas they could be valued at a much higher price, or look at other factors to this. So looking at ordinary shares, we will learn that they actually provide shareholders with voting rights at the AGM, which is the annual general meeting, and allow shareholders to receive a share in the profit of the company through dividends that are not fixed but are dependent on the financial results of the company, and also allow shareholders to receive an appropriate proportion of the value of a company's assets when it closes down. But remember that the Company Act is actually something that is started and is seen as something that will actually exist in the foreseeable future. So when they actually prepare the financial statements, they think in a way as in it will still be in existence in 5 years, 10 years time. So when we actually now move to the earnings of the company, the earnings of the company, their assets, their net profit, it is very important to know that shareholders do not have an automatic right to the earnings or the assets of the company. They are not necessarily owed anything by the company because the company is its own thing. But you must also look very closely to the MOI when you when you buy shares of a company, because it might stipulate that the company must actually issue dividends after a certain period of time and other moving parts as well. So the directors, in accordance to the Company Act of 2008, authorized payment in the form of dividends. So this is how the shareholders, or one way that the shareholders earn money. And what the directors do, they look at the results from the solvency and liquidity tests to actually ensure that the payment of the dividends will not result in solvency or liquidity problems in the future. So this is all happening in the meeting of the board of directors, and the minutes of this meeting are recorded and are actually given to the shareholders along with the solvency and liquidity test. But in the event that shareholders did not receive the dividend for that period, there are actually other avenues that the shareholders could explore in terms of actually making money. So one other avenue is actually selling their own shares. So they can earn money by selling their shares on a later stage when they are valued at a higher price. So imagine that you are a director and you are buying a share and you bought it, let's say at 1 rand. Let's say you bought it at 1 rand 50 cents. That you personally bought this share at 1 rand 50 cents. But you decide to sell it at 2 rand 30 cents after a, let's say, 4 years. Do you see that the difference is actually the profit that you've made from actually having the shares? So you're probably wondering, okay, if the company does make a profit but decide not to give the shareholders their earnings, what does the company do with these shares? Does it go into the director's pockets? You're probably asking us all such questions. But no, ideally it goes into the retained income. So the retained income is income that might deliberately be withheld, dividends that is withheld, and the purpose of this is actually to invest in what we call future expansion. So the company might deliberately want to retain income for future expansion rather than distribute dividends. And in other words, this means that the company may decide to increase the amount of its retained income, and this is essentially income which is kept by the company and not distributed to the shareholders. But also in this case, the shareholders they can actually gain money in a sense by a form of capital growth, because the company is going to get more capital by retaining more income and thus increase the price of shares. Do you see? So this covers this video shares and authorized shares, and as we get closer to our last push, that's the end, guys.